and welcome to the FinEd's YouTube channel. I'm Nidha Najib, the FinEd's co-founder. Today we're going to be discussing a very challenging topic, and that is deferred taxes. मेरे ACCA students को ये topic बहुत challenging लगता है, and I'm sure आपको भी लगता है. So let's jump right in. Before we begin, I want to highlight a very important point. And that is that the annual tax expense reported on a company's P&L or profit or loss statement is calculated by multiplying the profit before tax by the tax rate. This truth will never change. Now, even before we begin discussing deferred taxes, there's another point which I want to elaborate on, and that is that the annual tax expense being reported on a company's P&L isn't exactly equal to the amount of taxes being paid out to the tax authorities. Then what is? एक एग्जाम्पल देखते हैं और वो है अल्फा कंपनी का. अल्फा कंपनी ने अपने P&L में प्रॉफिट बिफोर टैक्स ऑफ $1,000 रिपोर्ट की है. Applicable tax rate है 30%. Multiplying these two figures will give us an annual tax expense of $300. Now here comes the twist. In order to determine how much taxes Alpha Company owes to the tax authorities, the tax authorities will not be relying on that $300 being reported by Alpha on its P&L. Instead, they will construct their own P&L statement, use that 30% tax rate, and calculate a new tax charge for Alpha. Now let's suppose that the profit before tax appearing on the authority's P&L is $2,000. Multiplying that 30% with this figure results in a tax charge of $600. Here we are seeing two tax charges being calculated for that same company. $300 on Alpha's P&L, $600 on the authority's P&L. Why is this difference arising? One possible reason for this is timing, and I want you all to remember this. In order to understand this timing concept, इस एग्जाम्पल को मज़ीद elaborate करते हैं. But first, we need to understand why there is a difference in the profit before tax being reported in the two statements. Let's study the profit or loss statements. Firstly, let's look at the sales line item. Both the authority and Alpha are reporting an identical sales figure of $6,000. Cost of sales is also identical and equal to $2,000, resulting in an identical gross profit of $4,000. Other expenses is also identical and is equal to $2,000. Next is the rental expense line item. Alpha Company is reporting a rental expense of $1,000. The tax authorities do not allow the recognition of the rental expense. This results in a difference in the profit before tax being reported by the two parties, and further on in the difference in the tax charge being calculated. Now, Alpha's accountants have used accrual accounting and have determined that the accrued rent comes to $1,000, which is the figure reported on P&L. However, around the world, tax authorities do not follow accrual accounting to construct their P&L and further to calculate the tax charge. They follow their own rules. This results in a difference often between the taxes being reported in the two statements. Now, in the case of Alpha, its tax authorities only allow the recognition of the rental expense when Alpha actually pays the rent out in cash. So this is an example of the timing differences in the recognition of rental expense between Alpha and the authorities, which gives rise to deferred taxes. Now, in order to understand whether this deferred tax is a liability or an asset, and in order to understand whether this timing difference is temporary or permanent, stay tuned to our channel for further videos. Please subscribe to our channel, follow us on Facebook and Instagram.